Okay, hello traders, and welcome to this live intraday strategy webinar. Today is Wednesday, May 3rd, and it is FOMC day. So we do have the interest rate decision on tap later today. I have a long list of things to go over today, guys. So on the docket, obviously we'll go over the dollar crosses heading into the release, dollar index, dollar yen, and Kiwi dollar being my three sort of focus from last night. Euro Kiwi, Kiwi CAD, and Kiwi Yen. I do want to touch base on all the yen crosses. Keep in mind, guys, the yen, as far as the yen crosses are concerned, it's the golden week in Japan. So today's Constitution, or yesterday was Constitution Day. Today's Constitution Day. Tomorrow's Greenery Day. May 5th is Children's Day. But the long and short of it is Japan is closed for the remainder of the week. So we just want to make sure that we keep that in mind if we're getting involved in the yen crosses. Nonetheless, we will take a look at some of those, the Kiwi yen and the dollar yen specifically. From yesterday's update, or the previous day's update rather, Aussie dollar levels remain remarkably clean. Euro Oz and Aussie yen, we'll go over those three. I did a whole new rework of dollar CAD. So I do want to take a moment and go over dollar CAD specifically as it pertains to the current structure that we're in. You know, it's been crazy. It's 8 days up now. Today would be 9 days up consecutive. I really still don't have any major key levels on dollar CAD till a little bit higher. So we'll take a look at that chart as well. And then from the Sunday update, sterling dollar and sterling Kiwi. Also sterling Kiwi playing out really well. We were looking for the risk to highlight back on Sunday. That has materialized rather nicely. Okay, questions from your end. As always, feel free to throw them on the message board. Graham says, hi Mike, hope you're recovering. Cheers, Graham. Thank you so much, man. I'm feeling great. A look at the short-term divergence at support for Aussie yen, which is on the docket. I got that for you. Vlad wants to take a look at EuroCAD Nat Gas. EuroCAD I don't have. Let me do that on there. EuroCAD and Nat Gas for Vlad. Gotcha, Vlad. No worries. Horace, good morning to you as well, sir. Okay, let's jump right in. So first things first, here's what the dollar index looked like last night, and here's what it looks like heading into the FOMC. Look, as far as this interest rate decision is concerned, we're not really expecting anything materially different. You know, they're expected widely to hold rates as, or they're expected to hold rates. A quick look at the interest rate expectations from the Fed Fund futures. You're still looking at a basically 12% chance that they'll hike. So there's really no expectations. Everyone's banking on the June hike, okay? As it stands right now, Fed Fund futures are pricing in 71% that will see a 25 basis point hike. So the focus is really going to be on the language in the statement, and if there's any alterations to that language, which would suggest that the Fed is a little bit more hesitant. Remember a couple of things. Last month's NFP numbers, we still do have NFPs on tap later this week, but last month's NFP numbers were rather weak. But the PCE, the personal consumption expenditure for the first quarter, came in right at 2%. That's the Fed's target. Unemployment's at 4.5%. That's the Fed's quote-unquote natural rate of unemployment. So the question being is, does this put pressure on the Fed to start to normalize a little bit more aggressively? Now, you could make the argument that with asset prices so high and with the markets rallying to where we are right now and expectations that the fiscal side of policy will really start to carry things. You know, you could make that argument, but at the same time, would the Fed want to raise in that environment? So it's stuck between a rock and a hard place. You know, I don't really want to get into discussions more than that as far as what the Fed can do, but from a trading standpoint, the dollar index remains right in a very critical, very readily identifiable range, highlighting key resistance into 99.53 near term and support at 98.69. We've been talking about these same levels for weeks, guys. So, you know, heading into the start of this week, last week's weekly opening range remains intact. So that highlights again this key near-term range right here. A topside break, you're looking for that rally into near-term critical resistance, 99.53. A downside break, you're really opening up downside targets into this slope line here. I would use that as a soft target. The real major support is going to be down here. My favorite fib confluence is 50% off the low from last year, 100% extension from the decline off of this year's high. Both those fib levels give you a nice little crossover here at 97.67, 97.87. So as far as the daily levels are concerned, you're still working with a really clean setup. Here's the intraday. Comparison to where we were last night, comparison to where we were last week, we're still holding that same godforsaken range. So look for this consolidation pattern to give out. I would expect that to happen today on FOMC if we get some sort of play. You know, how you would look to trade this, if we get an initial spike, depending if, you know, the tone of the language, if we get an initial spike into this region, I actually would be looking for exhaustion right into these parallels. Okay, possible short entries. If we close above that region, I mean, the risk is for a sterner recovery up towards the upper median line parallel. Keep in mind, it's the open of the month, guys, so we still want to stay super nimble. If we downside break, like I said, you know, right on target, we're going to continue to favor those downside targets unchanged from last week. So heading into the FOMC, watch 98.69, watch 99.53, major key range break here for the dollar index. Any questions? That is number one, DXY. Number two from last night, let's go over the dollar yen. Like I said, you know, it's a holiday in Japan for today's Constitution Day, so I don't want to necessarily get too aggressive on this, but because of the relationship with yields, dollar yen tends to be a very strong performer or a strong reactor to U.S. data. So a quick look at this chart. This is the dollar yen daily chart. We've been talking about 111.45, 111.08, or 111.10 for weeks and weeks. That was the opening range high for last month. It also converged here last month on the upper median line parallel. Obviously, we got that break and push, and here's the advanced testing 112.34. Here's what dollar yen looks like now. You know, that level still remains a near-term resistance. I think you could probe higher into this region before spilling down. Heading into the FOMC, again, very similar scenario. If we were to get a spike into this region, I would be looking for short-term, near-term short exposure. With the same respect, you have to stay supportive above 111.10 for now. This was a big pivot. We've been watching this region for a while. Again, this was not only last month's opening range high, but it was last month's open. So I'm more inclined to stay constructive above 111.10 near term in dollar yen. And again, 113.37, let's say into 113, big region of resistance. Again, if you zoom this out, just basic trendline resistance, nothing fancy here from the highs that we made for the year. So the levels remain pretty clear, and as I noted in the report, you know, I'm still kind of unsure how I'd want to play this at this point, but the levels are super clear. So if we rally first into this region, I'd be looking for that short. Again, if we pull back into support, I think you need to stay constructive still above that 111.11, 111.45 region. Questions on dollar yen? Sarub, silver, copper, please. Gotcha. Not too fond of copper here after yesterday's price action. I think it's a big fake out, Sarub, but we'll take a look. Okay, that is dollar yen. Next up on tap, Kiwi dollar. So you got really strong Kiwi dollar data yesterday. Really nice play, actually. It was a very nice fade opportunity. The data was the employment figures, which came out stronger than expected, fueled a topside break. If you remember Kiwi dollar from the previous session, you can take a quick look for the 5-1 update from here. We had noted that this was coming off of key support on Sunday. So on the rally, you were looking at 69.26, you were looking at subsequent targets at 69.50, and then 69.74 into 70.09 was sort of a region I was looking for some resistance. Well, on that next low that we made, or on the adjusted levels from yesterday, we stretched just shy of that 69.75 level, okay, just shy of it. And here we are in the pullback now at support at 69.09. So as yesterday's print was coming out, we were looking for near-term exhaustion at both those topside targets. Like I said, we just missed that 618, which was the initial level I was looking for entry. So unfortunately, I didn't have the real guts to get into this on the pullback here, but the pullback is now testing near-term support, 69.09. Okay, that's right here. So where do we go from here, Mike? Well, if this breakout is legit, well, let me take a step back. Here's what the daily chart looks like, guys, real quick, just to show you the severity and the significance of the level that we just came off, 68.16 to 68.85. You guys remember we were talking about this. Look to the left, December highs from way back here in 2015, close lows from way back here in December of 2016. Looks like a December thing. Then you have the opening range lows for the year. Then you have the 50% retracement of the entire advance off the 2015 low. So there's tons stacked up there, okay? And then that's why we were looking for the initial rebound here early in the week on Sunday. Well, we got it, and the initial rebound is now testing former support right back here. Okay, 69.69 was the level that we were looking at, 69.70. So not surprised to see some kickback right back at support. And again, look back to the lows that we made here last month on the opening range low. That's basically where we're sitting right now. So the focus range, the key range, is still 68.60 into 69.70. Okay, you're still looking at this as your range of focus for Kiwi dollar moving forward. Jump into the intraday charts. And it looks like this. So this structure could be in play at this point, and it further highlights that 68.60, 68.85 level. So this is still the broader bullish invalidation for the near-term advance. Now let me say this just for the record. I do favor Kiwi weakness broadly speaking, but when I title something, guys, as near-term bullish invalidation, that means for the immediate advance. So we came back into the week saying, look for the rebound off this level. It's a big, big support level. The risk is for a pop higher. That shifted the focus higher. This is now the bullish invalidation level. Okay, I do inevitably like selling the Kiwi, but this is the level we would need to break and move below to really validate continuation of the broader downtrend. Okay, and those levels remain pretty clear rather. So that's Kiwi. Not much Kiwi data is on tap for the remainder of the week. So again, we're going to want to keep an eye on dollar price action. Obviously, I have non-farm payrolls on Friday, so might be a decent play. Immediate focus heading into the U.S. Open is 69.09. I wouldn't be surprised to see a rebound off this level. At this point, let's just clean this up a little bit. That's near-term resistance. That's key near-term support. Immediate support right here. So on a rebound from here, that would be your target. On a breakdown from here, this would be, again, the last-ditch effort of where support would hold. And the invalidation level for the current rebound that we're seeing off support. Okay, ultimately, again, gun to my head, I would like to sell a rebound back towards here. If we get this, I'd like to sell it. Or if it just breaks down from here, guys, don't do anything until we clear 68.60. Look for a rebound or some sort of recovery to sell against that region. That's sort of my game plan here moving forward with the Kiwi. Any questions? Kiwi dollar, number 3. Going once, going twice. Keeping with the Kiwi setups, Euro Key, another one that we were following from earlier. Here's what Euro Key looked like last night. Okay, first of all, the daily chart. You'll remember this one. You'll remember this one from earlier last month. We were talking about Euro Key, the topside break of this key region, the median line that we were looking at, former highs and the opening range highs for the year, really opened up the upside targets with the advance coming right into a critical region, basic trendline resistance off the highs. You had a 50% retracement. You had the 2016 open, which, as I said, is not that big of a level at this point, but has been a very clear-cut pivot in price, so we've continued to eye that level. And the risk for a pullback still materializes with a move from here. So we're getting the pullback. Sorry, guys, got distracted real quick. We've got the pullback from here. And last night, we were coming into initial support, 156.82. Here's what the 4-hour chart looked like. Okay, so the opening range, in my humble opinion, is set, and the reason that that opening range is impressive is because the median line formation of the current slope actually has a really nice formation confluence right there. Well, that held an overnight trade like a charm, okay? And you got a nice little upswing. So you have a very nice weekly opening range just below critical resistance. Those are typically our favorite plays. Again, just to give you a quick zoom out of this basic trend line or basic median line analysis, support off the lows, take it to the high that we made back here on the 12th of last month. It literally clipped the high almost to the pip. Now take a buy sector, take a basic 50% retracement of the range and drop that median line there. And you could see really nice pivot, comes just lower, and at this point is highlighted by that 1618 extension from the advance off the lows. Okay, focus range 156.82, 159. It is a larger range, but this is a larger ATR scalp, so for sure you want to make sure that you have that in mind. If you're trading Euro Key, it's got a larger ATR, but the levels remain pretty clear. Okay, ultimately I want to be long this pair for sure, and I've been saying that. The question is, you know, do we get one more low into 150, 590, 156? This is sort of the butter zone. If we were to get a drop into this region here, I would be really interested in possibly getting back on the long side. It's either that or a break of 159 to the upside, because you still have some, well, you still have to break that major resistance that we rebounded off of and that long-term multi-year trend line. All right, so the level's pretty clear. I want to stay constructive above 156, looking to buy pullbacks while above that region, needing a break above 159 to really get this thing going in Euro Key. Any questions on Euro Key? That is number 4. All right, we're making good time. Kiwi CAD up on the menu next. Here's what Kiwi CAD looked like last night. And this one I was a little bit more aggressive with because the nature of the breakout was kind of, it fizzled out so quick. Let me just say that. It fizzled out a little bit quicker than the other ones. Here's what Kiwi CAD looked like. It came right through the upper median line parallel of this formation. By the way, if you guys remember this formation from a couple of weeks back, it's been ridiculously clear. You know, once that 50 line gave out, you got the spill to the median line. A little messy here last month into the close of the session here, but on the way up, got hesitant again around that 50 line. So once we got to here, you know, into the close of U.S. trade, I was thinking short. Just because of the nature of the upper median line parallel and basic trendline resistance. Forget the pitchfork altogether. It's basic trendline resistance. So I was inherently looking for exhaustion as momentum gets into, you know, that 70 region. Well, you got that data print from New Zealand, fueled some upside in Kiwi, but it came right into that 786 retracement. Momentum quickly turned over, and even on the near-term charts, it was showing signs of exhaustion. So the pullback already took out 95. Still looking for 94.69 here. I don't want to stress this 618 at this point, but it's definitely a level to keep an eye on as a near-term target. And let me also just add this real quick, guys. I just want to see what this looks like. If you do this properly, I bet you the 38.2 shows up right there. Okay, just below it, 94.62, 94.69. I think we're through the 236 already. Yep. So levels are pretty clear as far as the near term here on, I'll leave that retracement on there actually, just clean that up a bit. There we go. On Kiwi CAD. I'm not looking for full-on failure just yet because I do think that dollar CAD possibly has further upside to go like we talked about. That would be CAD weakness. So CAD weakness, Kiwi weakness might show a little bit more of chop sideways action, which is why I would prompt you guys, if you took this trade last night, be nimble, okay? As it shaves off to the downside here, go ahead and chip some off and be quick to bring your stops to break even as we enter the U.S. Open because you could get a little bit more back and forth. And specifically, if dollar CAD has one more leg higher, you know, it could just kind of offset this to see some more back and forth in Kiwi CAD. That being said, you'd need the break below 93.35, 94 excuse me, 94.35, 94.33, again, to shift the focus lower. If you look at this on the daily chart, if this formation break is legit, which we were talking about, and this, we're within the confines of this, this is still a huge pivot in price. And look how long it's been, that pivot. So that's still going to be my sort of bullish invalidation as far as the upside is concerned, keeping in mind that a break below this would also necessitate a move below the 200-day moving average, the 50 line, the reversal day close that we made back here on the 25th. There's a lot there. So just keep that in focus as far as what level would really shift and put the broader downside back in focus here for Kiwi CAD. Questions on Kiwi CAD? Hey, Karthik, welcome aboard, my friend. I'm actually looking at WTI. Would you also cover that? Yeah, sure. We'll take a look at crude prices. I'm not really a fan of where they're trading right now, but we can definitely take a look. You're in the right place. Pooja, Sterling Oz, please, holding a very tiny short. I think Sterling Oz was on the list. No? Well, it is now. Okay, let me pick up the pace here then. Okay, any other questions on Kiwi CAD before we move off? I know it's a little bit, again, a bit of an obscure pair, but if the clarity of the formation's there, I'm going to bring it up. Number 5. Okay, number 6, Kiwi Yen. A trade that, we've been highlighting for a couple of days now. Came into the upper median line parallel early in the week, and we've since broken through. And as I warned last night, I thought it was a false break, and it turns out, if you guys want to see my desktop, it did turn out to be a false break, or at least it's showing signs of that now. Here's what Kiwi CADs looked like last night. Here's what it looked like back on Sunday. Okay, just to put things in perspective. On Sunday, we highlighted, look, we're coming into basic trendline support. This is defined from the low that we made back in June of last year, not the stretch low that we made on Brexit, but just ahead of it. You had 1, 2, 3 tags, probe, failure, and that converged on the 50 line of the descending slope. I can show you here, I guess. And the 50% retracement of the entire advance. So we came into the week saying, guys, watch out. We're at support. I'd be looking for a rebound. The downside bias is at risk while above this region. Near-term resistance was right up here. You had the 200-day moving average. You had the former swing lows from May, 77.46 into 77.60. Okay, was the level that we were looking at. Fast forward, here's what it looked like last night. The data, stronger than expected Kiwi employment numbers, prompted a break, or prompted a rally of that. We went right into last month's open. Do you see that? Do you see that purple dot right there? And failed. And we moved lower. It's too early to tell, but if we close back below within the confines of this formation, this would be defined as your typical throwover, okay? Which is a false break of resistance. So it's too early. Like I said, it's too early to tell if that's the scenario we're looking at, but that's sort of what I'm focused on heading into the close today. Here's what the intraday chart looks like. And just to zoom out, you can see this formation has been pretty fruitful. Basic trendline resistance being tested now. The 50 line, well, that was an awesome pivot for weeks and weeks and weeks. The monthly open now converges on that key region. So you're going to want to go ahead and highlight that as our bullish invalidation level, or this is the breakdown level, as it were. If we get below that, that's your monthly open, your weekly opening range low, trendline support. I could keep going. But this is basically your invalidation level to open up the downside targets in Kiwi Yen. Not my preferred scenario. At this point, after this rebound, I do think you see some sideways action here. I think you see a consolidation break, give you a recovery before we move off. But largely, I would be attributing that to possibility of yen weakness, more so than Kiwi strength. So we want to make sure that we're gearing ourselves. You want to know what setup you're trying to play in the event of that respective currency's performance. So in the event of Kiwi weakness, this might not necessarily be my favorite pair. In the event of Kiwi strength, Actually, this would be one of my favorite pairs, especially if we're able to close above northbound of that Brexit high 70, what was that, 77.67 or some change. But watch this region into the close today. I think that's going to be the tell. And actually, this is just kind of popping out at me right now as I'm looking at it. Bear with me one sec. That's interesting. Guys, bear with me one more moment. I'm just going on the fly here. Now that we've made that secondary move, I just want to see what this extension looks like. There's the 618. There's the 100. Okay, some near-term targets on a possibility of a continuation and push higher would give you 78.37, which converges on this parallel right here. That's not too far off. Don't want to necessarily stress this 77.51 level, but it looks like it's offering some support. I'm going to go ahead and remove that. And one other thing, this is going to get crowded, but just bear with me. I do want to see what the weekly range so far looks like. Okay. Okay, so this is how I would look to play this, or what I'd be looking for over the next few hours and days, basically, over the next session or so. If you get the breakdown here, look for support here. If we're able to hold 77.15 on a downside move, I do think that you look for the continuation and the push back into 78.40, or at least the upper parallel. If we break down sub 77, meaning we take back 50% of the weekly range that we just set forth on Monday and Tuesday, I would be looking for a move back to slope support, key support, that longer term, key region just below 76.50. So, looking to fade a rally into here near term, or if we get that pullback and a hold, long triggers into 77.15, the 77 handle might be an opportunity to take another rebound in Kiwi Yen. Questions on Kiwi Yen? Okay. That was it from last night's update. I see more questions coming through. Hey, Sandy, great to see you. Euro Oz. Okay, Euro Oz is on the list. Sterling Oz, Pooja wants to look at as well. So we'll take a look at both of those. Next up, though, let me just go over Aussie dollar, guys, and then we'll jump into Euro Oz. I see a lot of interest in that. So first things first, Aussie dollar. I mean, what a beautiful play, I guess. I don't really. Well, I guess let me just show you the chart. Here's what Aussie dollar looks like, and here's what we were looking at earlier in the week. I mean, the levels are just stupid clear. Here's what the update looked like from the first, and we were heading into the RBA. We were talking about Aussie really coming into a big region of resistance ahead of 75.58, which is in my humble opinion the bearish invalidation level. You have the 200-day moving average. You have the 38.2 retracement of the decline from the highs. You had the upper median line parallel, and they all converged right there. So sort of the rally into here was where you'd look for some near-term exhaustion, and a downside break would really open up the southern targets. Here's what it looked like on the 4-hour chart heading into the start of the week and heading into the RBA rate decision. Inevitably we actually did get that spike right into key resistance, 75.58, before turning lower, and we took out the lows. Now trading more towards that 74. Well, first we're currently trading at 74.73 or so. So we're not quite there yet, but the rejection of this region puts into focus the basic weekly opening range. Okay. Here's what it looked like on the 120-minute chart right ahead of the RBA. Here's what Aussie looks like now. Okay, you can see we rallied right into the 200-day moving average, right into that gap between the 200-day moving average and the 38.2 retracement, and then again the turnover subsequent looks like this on the 4-hour. So as we speak right now, guys, we are testing the weekly open, okay, as support. So inherently and objectively, irrespective of what Michael Boutros says or anyone else, if we break below this level, price action would be giving us a signal lower, right? Market sets a low early in the week. The market sets a high in the Monday, Tuesday stretch. It's Wednesday. You look for that break of the range to give you a near-term directional bias. It just so happens that only 10 pips lower, though, you still have that 50% retracement, which largely held the decline last week. So I would be cautious about this region here, guys. You might get some dribble and some back and forth, maybe another rally back up into 74.90. But largely speaking, if we settle the day below this, we push below this, sub this key region, I am looking for a drop into 74.17, and that would be the initial target of where the 1618 extension of just this near-term decline converges on the median line. And certainly we've talked about how the fact that while the larger slope here hasn't really given us too many pivots just yet, all the parallels have been spot on. 1, 2, 3, 4, 5, 6. These two, not the cleanest, but it's there nonetheless, right? Pivots right off that high. So, I'm liking the fact that that converges on the 1618. Again, we'd need to get sub 74.55 to really open that target up. Near-term resistance, I'll be looking right back up at 74.91. And again, at this point, you'd want to drop your bearish or invalidation level to sort of this region, guys. I wouldn't want to hold it all the way back up into the highs. Even if we get a rally, you know what, I take that back. You still kind of have to leave bearish invalidation there. Even if we get a rally into the upper parallel, that might be a really opportunity to get back on the short side again. If the slope is the slope, still at 38.2, and that is the weekly opening range highs. There'd be no reason to get bullish, I guess, unless you get above 75.58. Honestly, I don't, again, my humble opinion, gunshot approach, I do not think we get anywhere near that high again per se, but on a rebound, that's what I'd be looking at. Now, I say all this with a caveat in that we're coming into the FOMC interest rate decision. So if Yellen comes out with something, or there's no presser, but if the statement comes out with some radical shift, which is highly, highly unlikely, but if they do, it's my job to prep you guys, and the dollar collapses, that's still the bearish invalidation level, meaning 75.58, if this pops, you're likely to see a big recovery in Aussie. This thing is pent down, and we've been getting divergence into those lows. So if we clear this to the upside, you're looking at like 76.30 as the first major level that I'd start to get concerned about. But that's sort of the game plan moving forward. Okay, weekly opening range is set for the Aussie. You're at near-term support. Watch 74.50 as 74.55 as the major support for the breakdown. Stay bearish sub 75.58. Questions on Aussie. Worst performer on the day, by the way, down 0.8%. Okay, so I'll leave it at that. Levels remain really, really clear. Okay, Euro Aus. You guys seem to have a lot of interest in this. Here's what Euro Aus look like. Again, if you go to the previous update, back from the 26th of the month, we were talking about Euro Aus coming into this. Where's the real chart? Coming into this major area of resistance. And here's what the chart looked like back on the, what was this? On the 26th of last month. 145.95, the 88.6 retracement, but that's not it. It was also the yearly open, or is also the yearly open, slope resistance. You have a lot to look at there. Well, guys, it's been over a week, and all we've been doing is chopping below that key resistance range. Now, we're testing it again today. Before anyone gets excited on the continuation higher, I do still want to highlight this major area of resistance right here. And the fact that euro dollar, which we'll take a look at, I do like a pullback in the euro first before we break to new highs. So for euro Oz, guys, if you're not already long, I don't know if I want to advocate any new additional positions on the long side from these levels. Euro Oz long yesterday, London range breakout for Sandy, still holding it. Could we have a look? So for Sandy, for you, I'm not sure where the position that you got in from. This is an area of which I'd actually be looking to take some off. This is the weekly open and that 46 range that we highlighted last week and capped the advance. You haven't gotten a close above this yet, and it's the weekly open. And you know what? Sandy was highlighting that too. Sandy was saying, oh, that was for you, Sandy. Yes. So, Sandy, it is the weekly open. Absolutely. Yeah, I'd be looking to take a little bit off here and actually bring my stops into to break even or better. 44.88 euro Oz was my entry. Nice entry. Nice entry. So you're up about a little over 100 pips here, right? I like it. Really nice entry. 44.88, 44.85 was sort of the support level that we had highlighted earlier on the pullback. So a nice gutsy entry on that one, Sandy. Well done. But look, what I wanted to highlight is this. If we do hold above this into the U.S. opening range, watch that trend line here in red. That brings into 46.70, so that's another 100 pip to the upside. And then obviously the swing highs from December taking to 47.19. But this is still an area of risk, in my humble opinion. Look, I mean, if price were to close right here, right now, Sandy, you'd have daily divergence and intraday divergence, or weekly divergence, which we've been following all week, right, since the highs that we made last week, which is why we were looking for exhaustion into this region to begin with. Higher high in price, higher high in price, higher high in price, lower high in the oscillator, lower high in the oscillator. So again, for the record, longer term, I love the upside of Euro Oz. I think this thing has turned a big, big corner. I think it's a big old bottoming process. And while we're talking about it, I just want to again highlight this major trend line, former support, now resistance, which is what will clear the way, in my humble opinion, for a much larger advance here in Euro Oz. Okay, so this dates back to the 2015 December lows. That's just higher. And just for argument's sake, let me also just take a quick look at this for you, Sandy. Ooh. Okay, that also puts a highlight. 46.23 is the 100 off the low. So 2 equal legs high does cap this advance also into this region. All right, I wouldn't be surprised if we see some exhaustion on this, Sandy. Maybe even a pullback into 44 would sort of give us an opportunity to possibly look for entry back on the long side. But be mindful of this whole zone. This is the close highs from December, the yearly open, and now defined by that 100% extension. So I'm going to go ahead and highlight this for you. Keep an eye on that key range. Okay. Again, a quick reminder, you can take a quick snapshot of any of these charts, guys, if you need it for future reference. Sandy, does that help? Both from weekly pivots. I still see that you're using weekly pivots. Nice. Yeah, you're more than welcome. Sterling Oz, we will take a look at in a moment. Let me get through a couple more of these pairs real quick. So any questions on Euro Oz before we move off? I'm liking the way this is panning out. Watch still for this resistance region to 46.23. And again, 47.20 is really the breakout zone here for Euro Oz. Aussie Yen for Pooja. I think you were asking about that, right? Someone asked about Aussie Yen here in the room. Sorry, let me just go through your questions again. That was for Graham. A lot short-term divergence support on Aussie Yen. So Graham, here's what Aussie Yen looks like to me, man. We've been following this one for a while. So here's the daily chart. So first of all, the breakout, as we noted earlier, if this breakout is legit, this is basically where we should be looking for support. I don't know if it's going to be respected just because the turn that we saw, well, it was above 50. Let me say this. Here's the broader structure. You guys know this was my trade of the year that I put out for Daily FX for the last 2 years. We were looking for the pullback early in the year to get long. Well, early in the year, you didn't get a pullback. In fact, early in the year, we rallied right back into resistance, which is what we called last year. And then we're pulling back here in the second quarter. So while we were looking for a steeper pullback to get long, now that the pullback came a little bit later in the year, the rebound has me a little bit more assertive, or a little bit less aggressive on the long side of the Aussie because of what relative performance of the Aussie in and of itself is doing. So for me at this point, from a technical standpoint, I still do like the Aussie to the upside, Aussie yen rather. But from here, you want to see a little bit more validation of what's going on. I don't like that we're kind of running through the 2017 Open, reversing back below it. If we broke this formation for real, it should be held as support. So for me, I don't think it's an operable trade right now. I want to see how we open up the week. Here's what the intraday trade looks like. Okay, 4-hour chart has us within the confines of a nice ascending median line formation. Here's what the chart looked like earlier in the week. Okay. And we were highlighting this resistance into 84.30 into 84.41. Now we came into it and we did probe above. Give me a little bit of leeway here with a 52 print on the upside. We sat there for a while, and here's the final pullback. For me, I don't have a play from here. Why? We're right slap in the middle of the weekly opening range. So here's your opening range low. Here's your opening range high. We're right slap in the middle. So I don't really have a play from here, although if we were to get a spill down to 83.50, which is another 40 pips, or even 83.60, this would be a region of which I'd be looking for some near-term exhaustion. Basic trendline support off the lows, nothing fancy, and former median line resistance. If this break is legit, like I said, should be support before you move off. So the focus for me is to watch this thing, see if you can get a dribble a little bit lower towards that target. And again, topside levels remain unchanged here on Aussie yen. If we slip below 83.50, you're done. You're looking for a move back into 83. You're looking for a continuation back into that longer term slope that we were following essentially from the 2015 lows. Any questions on Aussie? And so for Graham, for you, short-term divergence at support. I see what you're talking about. If I bring this into a 30-minute, I can see what you're talking about as far as divergence. Price action is making a new low, new low, new low. Big old reversal candle here on the 30-minute does actually make me shift my focus higher. But my question to you is, where do you put your stop on this kind of trade at this point? You could put your stop against the lows, but we haven't even opened the U.S. opening range yet. So what tends to happen when just at least from personal experience, Graham, what tends to happen for me is if I front run the open sometimes, the market will open, traders will come, test support again. I'll get stopped out because my stop is just against that swing low, and then the continuation of the rebound will materialize. Or a lot of times when you're gravitating towards a near-term support, the open will just press it right into it, and you'll actually get that dip into the final stretch you're looking for. So from a timing standpoint, I'm a little hesitant because we're not at resistance and we're not at support. Yes, 83.76 was a near-term target, which is kind of what we're sitting at now. But the whole focus, if you remember from the last update, was to take a short against this key region of resistance. So if anything, you should be looking to booking your profits on the short at this point. As far as trying to fade the decline, I need to see a little bit more compelling price action, in my humble opinion. I mean, you're already 20 pips off the low, but you didn't have much of a trigger. And it's kind of just shooting in the dark because, like I said, you're not quite at support from a structural standpoint. So we'll see for Aussie yen, but broadly speaking, that's sort of the game plan. This is your near-term bullish invalidation level. Does that make sense, Graham? He says, yes, thanks. He says, thanks. You're more than welcome, sir. So that is Aussie yen. 7, Euro Oz was 8, Aussie yen was number 9. Okay, and that covers everything from the latest updates on our intraday charts. I do want to take a moment to speak about dollar CAD. Obviously, the 430 update we didn't go over. The 430 update did highlight the sterling crosses. I do want to go over that as well. Those are all still relevant as far as sterling dollar and sterling key. I see a lot of questions here, guys, so I'm going to start to pick up the pace a little bit to try to get through all of them. But before we do, one last thing. I see a question here on crude as well. Guys, dollar CAD. You know me. I've been trying to get a handle on what's going on with dollar CAD for the last couple of days, and you know, if you guys recall a couple of weeks ago, or even the start of last week, I believe it was trying to take some shorts against what I thought was pretty compelling resistance at the December highs, at the November highs from last year. The 50% retracement, it was 35.75 into 35.60. Tried a couple of times, got stung. Okay, we broke through, and this thing is on its 8th day, or it completed 8 days up yesterday. Today would be 9 days up. So what the heck is going on? Well, this is my interpretation. And again, I kind of did a whole rework of this, so bear with me real quick, and then we'll jump into the other crosses. I'm not ready to operate on this, just as a disclaimer, but things I'm looking at, Jamie's absolutely right, or I'm on the same exact page as he is as far as levels, and you guys have heard me talk about this level ad nauseum. It felt like it was a mile away, but it's now pretty close, 138.15 into 138.30. Huge region. You're looking at the 1618 extension of the advance off the low. Okay, so boom, boom, boom. It's the 1618 extension. It is the 618 retracement of the decline off of last year's high. So just last year's entire yearly range. It's the 2016 open, so where we opened last year. And it's the 50 line of this newly added median line formation. And again, this is something I just added. So by the way, you take a quick look at this basic trendline support. If you extend it to these highs, I was looking at this as sort of an area of which, you know, we haven't closed above it. I want to see if we close above it or not, but don't stress that, all right? I'm just putting that on there for color. The focus is really on this basic trendline support and the parallel extending off the November high. So you still have room, and that converges, again, just higher on that key region of resistance, 38.30 into 38.15. All right? Now, if you take a near-term pitchfork just off of the extremes of this year, again, the median line, resistance, pivot, has been support for the last 4 days. And that 50 line converges right up there as well. Okay, guess what? 135.75, 135.60, the former highs, that key region that we were talking about, that we were trying to short against earlier last month, that now converges on the 50 line as support. All right, so the levels are starting to map out pretty clearly finally on the longer term charts, which is for me very comforting, very comforting. To go back to the intraday now, so what does that mean, Mike, for near-term price action? What the heck are we supposed to do here? Well, look, you're still in overbought territory, so don't get too excited about trying to fade anything just yet. Although, if you look at crude, I do have that coming in some near-term support. You could get an interruption. Wouldn't necessarily be looking to play the downside too aggressively, but near-term support, immediate support, now at 36.65. Okay, bullish invalidation, 35.75 into 35.60. Here's what the intraday chart looks like. Right? Might look a little busy, but let me just break it down for you real quick. Again, there's that critical region of resistance, an area of which I would definitely be looking for some possible exhaustion, possible entries on the short side to play the kickback. Now, if you're holding long exposure in dollar CAD here, ain't no reason to get out unless you see a break below the weekly opening range low, 36.40. And again, bullish invalidation still way down here. So that's sort of the game plan. If you're long, look to play those longs towards the 38 handle. If you have nothing on the plate right now, I'd be looking for entries on the short side up here, or if we do correct lower below the median line, possible entries on the long side down near 35.50. maybe even starting at 598, I'd start to look for some entries on the long side here for dollar CAD. Any questions on the loonie? So with that in mind, we'll take a quick segue into the crude prices. Again, I'm not a big fan, Karthik, of crude, of where it's trading now. I do follow prices very closely as far as what crude is doing, but this is what I would be looking at. And here's the update as far as the daily chart that we've been following. So I have us coming and testing near-term support. Now, this support structure is basically based on a basic trend line, simple trend line off the lows that we made, oddly enough, April of last year. Again, tagged in August. We tried to probe through it, couldn't do it in November. Tried to go for a tag of it last month, couldn't even get that, back in March rather. And here we are. Yesterday we closed just above it. Today's close is paramount. And this is why, for me, I don't really know how I want to play this per se. I still think dollar CAD has some further upside, which means, crude weakness, CAD weakness. But at the same time, this is pretty precarious here. So what you're looking at 48.12 was actually the low day close for last month. These tend to be important measures, specifically when they converge on structural support. Well, we closed just around there, okay? We closed at 48.04. What's 8 cents? Long story short, the close today will be paramount. Again, you got that 618 at 47.16. You've seen how many times that's offered support. So I don't know what to do here. And Karthik, that's okay, right? You're not gonna. We have tons of other setups that are have us at a much more clearer conviction levels. On this type of trade, I think you need to let this range pan out. Below the 200-day moving average, you saw what happened. Below the 200-day moving average here last month, we came right into that 618, and we sat in that range for 3 weeks almost, 2 weeks. So, do we get some more kickback here? I don't know, which is why I'm a little bit more hesitant, and I'm starting to like the dollar CAD chart a little bit more. If we get some clarity on that move, I think I'll like this loonie chart a little bit better. But on whole, you're coming in some interesting support, man. Above 47, I do not want to get caught trying to enter new short positions. Let me just say that. Okay, sub 47, I think you're good to 45.77. But above 47, I'm not looking for any new short exposure from here. Nice old haha, thank you. Hey, you're more than welcome, man. Welcome aboard too, Karthik. All right, so that's a quick look at crude prices. That's number 11. Okay, sterling dollar and sterling key. As we run towards the end of the session here, sterling dollar, really quick, I just wanted to highlight that the levels that we were, there's no change. Let me just say that. There's no change to the levels that are on the intraday charts. So we're right back in that same key opening range for the week. Look for the break. Again, near-term key support 128.27, near-term key resistance 130.56. And you're basically just looking for a break of the weekly opening range. Again, heading into the FOMC might be the charge that you need for the move here. Again, broader focus remains to the upside in the sterling, but you are looking for some possibility of near-term exhaustion if we do move below 128.30. Okay, constructive above 126.71, 127. Any questions on the pound? I mean, I think the setup really hasn't changed much, so I don't think we should spend much more time on that. 11, that's number 12. Sterling key is also a trade that we've been following. So again, sterling dollar, no change to any of these levels. Sterling key from earlier in the week looked like this. I did want to just highlight on this trade that as far as the daily chart, we got the reversal that we were looking for. The question is, how deep do we pull back? We got it pretty close to the target that we were looking at. So, excuse me, 189.20 was the level of interest. We turned just ahead of it. We didn't quite get that high before reversal, and we did highlight this in the webinars about the reversal and the fact that we pulled back pretty abruptly. Here's what the intraday chart looked like earlier in the week, right on the Sunday open. I thought we were going to get one more spike into that region, but we didn't. And And now we're trying to focus on this pullback and how deep do we get. The formation is remarkably clear, guys. So I personally think you still get another low before you play the rebound. But here's what the intraday chart looks like. And before we do that, let me just highlight again. We're talking about a break of a multi-year formation. Okay, now it's only a 2-point touch. Again, 2-point touch is typically speculative. 3-point touch is validation. But also a couple of median lines, a couple of parallels have also offered some pretty decent pivots in price. So again, if this legit is clean, if this break is legit rather, we should maintain resistance or support above former resistance at 83.50. Okay, that's sort of where I want to stay constructive above on Sterling Key. And this is sort of your main region that you need to get through as resistance. Okay, 90.46, 89.20. Once we clear this, I think you got a lot more freedom to the upside as far as your targets. 92.40. Longer term, you're looking at the 50 line. That takes you as high as like 94.80. I'm really thinking you get a lot more upside here to go longer term for Sterling Key. Near term, though, immediately, I do think you look for a new low. Here's what the intraday chart looks like. All right, so maybe another rebound towards the 87.40 level, former swing lows, that 236 longer term. If you take a retracement just of the weekly range, a little bit higher. Let me see where that 628 comes in. A little bit bigger of a range, but yeah, sort of right here. Would be an area of interest for possible exhaustion on Sterling Key. But I'd be looking for a drop into this median line. More importantly, what's the word I want to use? More convincingly would be a drop into former trendline resistance, now support, and then a rally higher. So like 83.49, 83, the 84 handle, like down here. So an interesting setup on Sterling Key, and I just wanted to highlight that the levels remain really, really clear. Okay, so keep your eye on that daily chart. It's really the only thing I've been using to guide me on this one moving forward. Okay, that is the rest of the stuff that I have on the menu for today. So let me jump through and get as many of your questions, that was number 13, out as possible. EuroCAD for Vlad. Did we go over that one? Okay, EuroCAD. Oh, this guy. Yeah, right. So. Yeah, I mean, I don't even have a play on this. The only thing I would say on this one is that watch that near-term 2016 open, which takes you basically into 50.21, near-term resistance target. This thing, you know, the combination of obviously the CAD weakness that we've seen and Euro strength has taken us through some pretty radical highs. I'd be looking for some near-term exhaustion, but I wouldn't have the guts to try to fade this just yet, specifically as momentum remains in overbought territory. Remember, as long as that condition holds, the market has the push behind it. So I don't think it's just quite ripe, ready for the fade. Let me see what the intraday charts look like. Building divergence for the last couple of weeks. But remember, divergence has nothing to do with time. So we can continue to mark divergence for the next 3 or 4 days before this turns. But the levels actually are pretty clean. I wouldn't really change any of this. Drop the May high. This would be pretty big for me because it's the opening range low for the week at this point, that 100% extension. So I'll leave that. But the levels actually remain unchanged on this one from last week's update. So if you go on the intraday charts on this one, Vlad, it's going to be the same as what I have now. This is sort of a barrier of entry as far as topside last-ditch effort of resistance. I mean, again, put a gun to my head. Yeah, I think you look for some near-term exhaustion on a pull into this region on a dump lower, but it's just not there yet. It's just not primed yet. It's just not primed yet. But if you put a gun to my head right now and tell me what do you do, I would say look for exhaustion heading into 50, heading into 50.22. Okay. Karthik, WTI. Here's what crude looks like as far as prices are concerned. Oh, we covered that already. So we did that. EuroCAD. We got nat gas. Nat gas. Also, nat gas is for Vlad. So this one's an easy one, okay? Vlad, it's the same chart that we were looking at last month, man. There's no change to any of those levels at all. If anything, it looks like it could be making just some near-term channeling as far as this decline is concerned. That's pretty clean. Actually, the lower median line parallel or the channel support now converges on the 200-day moving average down here. That would be your key support. Resistance remains unchanged. You know, we were looking at 319 last week. I know we spiked through it a couple of times, but now you have the median line or basic channel resistance just above it, and you have a pretty clean monthly opening range. So in my mind, Vlad, last month's opening range never gave out. Okay, you did see this spill that we made back here on the 24th and 25th, but we didn't get the close below. So last month's opening range is preserved. That just puts the emphasis this month on a continued break of that range for near-term price. So yeah, I would be looking immediately lower, and I'd be looking for that low to find some support near 3 for possible entries on the long side. The only thing that would put me on the constructive path again, or the breakout, would be a close above 320. And even then, you're only looking for a rally to the upper end of that range. Okay, don't get. We have to clear last month's opening range to really get this thing going. Does that make sense? So that is nat gas. For Sarub, I haven't forgotten about you, buddy. I'm over on time, but I've made my promises to you. Here it is. Here's what gold looks like. You guys know where I stand on gold, okay? We talked about this last week. I think you still look lower. I think you look that low. Near term, I do think if the dollar finds some support and does give us a little kickback before it turns, we talked about the index earlier in the session, right? If we get the weekly opening range to the upside and it gets that rally into resistance before we turn lower, you could see gold prices give us a spike lower towards 1241. You guys remember that's the level that we were talking about. Really nice pivot in price on the longer term scope. It's also a pivot of this 50 line for the multi-year formation that we were talking about. Again, you've all seen this weekly chart, but the weekly chart of gold also highlights that longer term ML. Where's it, the 618? Nope. Okay, it's a different one that we're looking at here at the weekly chart, but just to put things in perspective, where we turned, big region. Breaking below the 52-week moving average here, okay, keeps the focus lower. 1234, which is the reversal day close on this outside day that we made back here. This is weekly, excuse me, outside week reversal, converges on that median line. That's the one I was looking at, right down here, 1235. So if anything, I'm still in like sell the rally mode, I guess, for gold prices. 1278 being the extreme of which would put me back on the constructive path. Largely speaking, longer term, you guys know I'm constructive gold. We're playing the correction off of key resistance here. So, you know, monthly open resistance, 1267, write that down in your books. That's initial resistance. Bearish invalidation, 1278. Break lower, you're looking for 1241, 1230 on a drop lower. But initially, I'm looking lower sub 1267 here. All right, Sarub, that's gold. Silver prices look like this. You know, that's just coming into a basic slope resistance extending off of these highs. I don't really want to stress this either just because this trade is on its, I don't even want to sit here and count, guys. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days, 14 days down with today. I don't even think we've seen that before, you know? Momentum's in oversold territory, so I'm not going to try to fade this just yet, but coming in some slope support, not Fibonacci support. Fibonacci support comes in lower here. I guess the first area you'd start to look for would just be a basic 764 retracement. And even that doesn't come down until 1635. So structure to the decline. Let's see if we got it. Perhaps, but that would still highlight a drop even lower towards 1635. All right, here are the amended levels I'd be working with, Sarug. So I'd be looking for some immediate resistance near 1685, this median line here off the highs. So this would be sort of my near-term bearish invalidation level. A break above this would also necessitate a move a little bit higher would be the weekly opening range highs. So in fact, let me do that. That's near-term resistance. Weekly opening range highs converges right on the median line over the next 2 days. That's 1699. Let's just call it 17. On the downside slope, these parallels haven't been too fruitful. They're based off of these levels, guys. And if you took a parallel, it actually was really close to that other high, which is why I've been working with that slope. You can see that same slope caught support, support, pivot, resistance, then became support, support again. So I've been inclined to work with that slope. I would be saying, I'd be looking for some exhaustion on the downside here as we move into these targets. If we get a rally back towards 17, it's the first area you'd look for resistance if this is going to continue to hold for that drop into 1635, 1626. But the levels are pretty clear, I think, as far as what you want to be looking for from a reaction standpoint. The question is, do you get to 17 first for the last drop, or does this thing continue to drop lower? If it continues to drop lower from a trading standpoint, you really don't have a new entry to work with. You'd need to be waiting for that drop towards 1727, 1735 for re-entry on the long side for a rebound. Pooja, Sterling Oz, last but not least here. I'm way over on time, but to fulfill my promises, Sterling Oz looks like this. Okay. Yeah, you're tempting a break of the weekly open, of the monthly open, of the weekly opening range highs, but still that slope remains intact. You can see these are our targets and our levels from last week, or last month, I guess, at this point. With this being the extreme, we're still holding above that. So in fact, I'm going to put that as near-term support. Top side, obviously, respect just the high that we made last month, but I don't really have any near-term targets beyond that. Gotta go to the daily chart here to find the next one. And that's not till 176. Okay, something just to keep an eye on, but you're coming in some resistance either way. I know we're breaking through the monthly opening range highs, but last month's extreme and the yearly high is basically right here. So you have to watch for that break, and especially because the median line of the near-term structure of this slope comes in at the same spot, that's an area of interest, Pooja, I'd be looking at. Yeah. Yep, you got it. More than welcome. All right, guys, I'm going to wrap it up here. We'll see you all tomorrow morning. Keep in mind, Jamie is on tap at 12 o'clock with the weekly strategy webinar. Watch the 2 p.m. print, okay? We have the release of the statement. Should be pretty abrupt. Markets will just be looking through the statement. There's no press or anything like that, so we'll keep you updated if anything really a parent comes out on a change in the language. But that is on tap at 2 o'clock, and we'll see you tomorrow morning at 8:30. Best of luck trading. Until then, cheers.